Thanks for joining us at this festive Magellan briefing, the last one for 2016. Today I'm speaking with our Chief Executive and Lead Portfolio Manager, Hamish Douglass. Hamish, welcome to the festive season.
Thank you, Frank.
Now, we might just get serious for a moment. Hamish, the things are happening obviously in the world. What are the big issues on your mind right now?
Well, I would probably categorise it into three big issues that's really I'm thinking about at the moment. The first one would be, what is the direction of global monetary policy over the next 3 years or so? And there's a lot of global events going on in the world that will interact with the direction of monetary policy. And of course, where interest rates are in the world is going to be critically important to how equities get valued. So that would be the first one. And it's probably a shorter term issue that we're thinking about. And we've been thinking about this issue for the last 18 months or so. And it would appear that short-term interest rates in the United States may be about to start moving again. And we've had a large movement in the bond markets since Trump's been elected. So we're watching that very carefully and thinking about the global events that could interplay with monetary policy over the next 3 years. The second issue, which is kind of a longer term issue and I think a fundamental issue, is really what is the long-term risk-free rate that investors should be thinking about in terms of valuing assets. It's critically important. Historically, you would use a long-term average or use what the 10-year Treasury yield may be in the United States. Historically, before we had the financial crisis in 2008, you may have used something like 5% risk-free rates. The problem in the last 7 or 8 years is there's been no market indicator. You can't go to a Bloomberg terminal and tell you what the risk-free rate is because the central banks, through quantitative easing, have effectively distorted and deliberately distorted for stimulatory reasons long-term interest rates. So you can't go to the 10-year Treasury yield and say that's the risk-free rate for valuing equities. To some respects, we're just all swimming here in the dark. So we're giving that a lot of thinking. And fairly recently, we have very modestly reduced our long-term risk-free rate assumptions, materially above where they are today. So I don't think we're getting caught up with this distorted reality. But that's very important bearing about how we view the long-term valuation of equities. And the third big issue on my mind, and probably wouldn't surprise the listeners, is what is going to be the longer term effects of technology disruption? Are we actually going to eventually see massive productivity gains, deflationary forces, maybe through huge enhancements of productivity through technology? How will this impact different business models? And in the very long term, how will it affect valuation of assets? And will it eventually affect interest rates as well? So really 3 chapters about the shorter term, what's going on in monetary policy and interest rates that's really going to affect asset values, the long term of how we think about long-term asset values being the risk-free rate, and then eventually how technology disruption fits into this total picture.
And how do you feel about the risks associated with Europe at the minute?
Well, again, European risks really go to the first issue I was raising, which really goes to the direction of monetary policy at the moment. I would say there's two issues to think about in Europe. The first is the tail risk of Europe, and the tail risk of Europe is, will the euro collapse? And there's a lot of debate on that topic with things like Brexit. We've got a number of elections, very important elections coming up. We've obviously had a referendum in Italy. Very recently, the Prime Minister Renzi is going to step down. I'm actually quite relieved that referendum went down because I actually think it potentially increased the European risks if you gave unilateral power to a party coming in for 5 years who could be more radical without checks and balances. So I actually think Renzi perversely losing, even though it looks a bit of instability, is actually creating more of a muddle through stability scenario in Italy. We've got other elections in the Netherlands early next year, then we've got the French presidential elections, and we've got the German elections. Are any of these going to lead to the tail risk of the euro totally collapsing? We put that at very low probability. I think there's a very long pathway before you'd actually get a total collapse of the euro. But if that was to happen, that could be catastrophic for markets. But we put that relatively low probability. Probably the bigger issue with Europe is, will these elections and movements of parties and policies come forward proposing other referendums? Will that create more uncertainty? And more uncertainty is going to make central banks more cautious. So again, that will play into the speed and direction of monetary policy, particularly out of Europe, but it will feed into other areas of the world. So whilst we're not at the Armageddon, the euro's about to collapse anytime soon, we do see some potential speed bumps coming in Europe, and I'll probably be amiss if I don't mention the Italian banking system, dramatically undercapitalised at the moment. The oldest bank in Italy, MPS, needs a large recapitalisation. The Renzi referendum has probably made that more uncertain than ever. At the moment, it may need some form of state bailout. Could that cause contagion risk in the Italian banking system? Possibly. Again, I would describe that as a speed bump rather than a catastrophic event for Europe.
And how has the Trump election influenced your thinking?
Well, again, it's influencing direction of monetary policy. I don't think Trump economics is fundamentally going to change the long-term direction of the US economy, despite all its promises. But in the short term, if they do put through some tax cuts and cut back on some regulation and decide not to enter into a trade war, making some assumptions here, that's probably going to be somewhat stimulatory for the short-term aspect of this cycle of the US economy, which is probably going to put further pressure on the Fed to get going on increasing interest rates. So if anything, and I think you're seeing that in the bond markets and you're seeing it in the futures markets in pricing, higher probabilities of the Fed moving now. And actually the employment market's pretty strong. The underlying economic fundamentals are pretty supportive of that case. So if anything, it's probably pointed in a direction of a tightening of monetary policy in the United States. But is Trump economics going to fundamentally change the direction of the United States positively or negatively? Slightly short-term stimulus, but in the long term, you don't just change the fundamental direction of the economic ship by changing some short-term economic policies.
And so maybe talk us through the current positioning of the global equity strategy at the minute.
Well, probably not surprising that we're very focused on technology disruption. We've approximately got 35% of the fund in some very different technology-related investments, and we're very relaxed about that. We own some big consumer platform businesses like Alphabet and Apple, very large positions of ours. We like some enterprise software businesses. Microsoft has been a very successful investment for us. Oracle's another investment. We have some investments in semiconductors. We have some investments in e-commerce via our eBay investment. On top of that, we've had a long-term positioning around digitalisation of the world and move to a cashless society. People know we've owned Visa card and MasterCard, and we own PayPal that we picked up through the spin out of PayPal out of eBay. So we're very comfortable with that, and that's almost half our portfolio. We've got a few other directional investments around the US economy. We still own our Lowe's position, which is a housing position. We own Wells Fargo at the moment. Now, we actually recently increased our position in Wells Fargo during the account opening scandal. We think if, with Trump and tightening of monetary policy, if that happens, we think a business like Wells Fargo is quite advantaged by that. But it's a very, very solid bank, and we've taken advantage of some short-term instability to increase our position there. What we are very underweight is what I'd call low volatility consumer staple type assets, and we've got 15% cash at the moment. I'm feeling very comfortable where we think we are in the monetary policy cycle of being underweight that area at the moment. But if rates do start to move and those assets start to get repriced, they actually have started moving since Trump's been elected. Some of those assets are becoming more attractive. But if we have a rate increase and we have some direction, those assets could become quite attractive. So on the cash and low volatility, I'm being patient at the moment, but feeling quite comfortable having that firepower available to us. So overall, the portfolio in its different constituencies, I'm pretty comfortable about at the moment.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. We wish you a very safe and happy festive season and look forward to seeing you in 2017. Thanks.